Hello everybody, this is Philipp Jonas for Kalamazoo Valley Community College, and today we're going to discuss the basic tools of finance. So in our last lecture we discussed the basics of the financial system, but in order to get a better feel for how certain basic macroeconomic financial principles work, you also have to be familiar with basic financial concepts such as present value and risk, along with something called the efficient market hypothesis that we'll discuss at the end of this lecture. But let's discuss present value first. Finance deals with money that flows at different points in time. But if you have $2 figures that happen at different points in time, you can't directly compare them or do any other type of math such as addition or subtraction. That's because money has a time value. Not only in the sense that inflation changes the value of money over time, even if there was 0% inflation, the fact that you can use earlier money in order to earn yourself a rate of return means that receiving money sooner has a higher value rather than later. So the first step in tackling a financial problem where money flows at different points in time is to convert those money amounts to their equivalent at the same point in time. Now, theoretically, we could choose any point in time as long as it's the same for all of the cash flows, but a standard is to convert all cash flows to their equivalent present value, as in, what would they be worth right now? Let's start out with a really simple example of comparing this present value of a sum to its equivalent value in the future, which is of course referred to as the future value. And a really easy way to make sense of this is to start out by going in the opposite direction, if you will. Let's start with the present value and carry it into the future. That allows us to use the example of a savings account. Imagine you placed $100 in an account that pays 5% interest. How much money would be in this account 1 year from now? Well, assuming that we're operating under the simplest possible compounding rules, the interest gets paid once a year, you could of course calculate this by taking your $100 and adding 5% of $100 to the amount, giving you a total of $105. So one more time, that's $100 plus 5% times $100. Now it'll be useful to write this in a mathematically more compact fashion. By taking out the common factor of $100, we can rewrite as $100 times 1 plus 5%, giving us the $105. Notice here that I've converted 5% into its equivalent decimal notation, 0.05. All right, that's 1 year in the future. Now what if we go 2 years into the future? We won't simply be adding another $5. That's because in the second year, we'll be earning 5% interest, not just on the original $100, but also on the $5 interest already earned, so-called compound interest. So in the second year, we're taking the $105 and multiplying them by 1 plus 5%. Or expressing this in terms of the original $100, we'll be taking $100 times 1 plus 5%, that gets us to 105, times 1 plus 5% a second time. Or $100 times 1 plus 5% to the power of 2, which gets us to $110.25. The 25 cents, of course, is the compound interest. Let's do this one more time. What if we'd left the $100 in the account for 3 years? Well, you can probably see where this is going. We take our $100 and multiply by 1 plus 5% 3 times in a row. Or in other words, $100 times 1 plus 5% to the power of 3. Notice how with each year we go into the future, the exponent on our 1 plus 5% ticks up to be equal to the number of years into the future we're traveling. So in general then, we can take this $100 into any number of years into the future by taking 1 plus 5% to the power of the number of years that we want to compound. This is often an easier way to start thinking about compounding, taking a present value into the future. Now, let's start out by replacing the numbers from the specific example with their standard symbols. You're now already familiar with FV for future value and N for the number of years. The $100 that we put into our account to start with, that was a present value. That was today, abbreviated PV. And finally, we use the lowercase r to denote the interest rate in decimal form. So here's the generic version of this equation. FV equals PV times 1 plus r in parentheses to the power of n. But as I mentioned, most of the time what we'll be doing is taking a future value and converting it into a present value. So let's rearrange this formula. Present value equals future value divided by 1 plus r to the power of n. Most of the time you'll be using the formula in this version, but of course it's the same formula as before, just slightly rearranged. Now let's go ahead and use this math to show how it drives a very important type of decision making, and that is investment decisions. So here's our present value formula again, and now we're going to have a look at an investment decision. Let's say General Motors is thinking about building a factory. If it does so, it'll cost it $100 million to build. Of course, this factory will also yield revenue. Let's say it is $200 million worth of revenue that happens 10 years from now. Now, first of all, this example is of course simplified. In real life, investment decisions are expected to have cash flows that happen multiple times in the future. And because they happen at different points in the future, you have to convert each of them separately into their present value. That's because, again, you can't add amounts together that happen at different points in time. So if this factory had a payoff in years 2, 3, 4, and 5, each of them separately has to be converted into a present value and then added up. But let's stick with this simplified version to really drive the point home of how present value is used in decision making. General Motors is confronting $2 figures, a cost that happens today, so that's a present value already, but a benefit that happens 10 years in the future. In order to compare these two numbers, we have to first convert them to the same point in time. The standard is to convert them to the present value. So let's go ahead and take the future yield of 200 million and plug it into our present value formula. $200 million in 10 years. $200 million is the future value, and we're dividing that by 1 plus 6% to the power of 10. After rounding, that'll come out to be $112 million. Maybe take a second and pause the video to make sure that you can do this math on your calculator. Now, the most important part. What's the meaning of this result? We're now looking at $2 values that are at the same point in time. It costs $100 million to build the factory. It yields $112 million to build it. Since the benefit exceeds the cost, this decision is worth it. Building the factory is a yes, if you will. Once everything is a present value, it's as easy as comparing the numbers. Let's do this again. I'm going to look at the exact same factory decision and only tweak one thing. Let's change the interest rate from 6% to 9%. Is this enough to change the decision? Again, we determine the present value of $200 million that happens 10 years from now. It's the same factory. It's expected to have the same yield. But if we plug 9% into our formula, 200 divided by 1 plus 9% to the power of 10, we find that the present value has fallen to $84 million. So at this point, you'd be spending $100 million to make $84 million. The factory is no longer worth building. Not because anything has changed about the factory, but because the opportunity cost of the capital has changed. If we're discounting future values at a 9% interest rate, they are worth less than if we're discounting them at a 6% interest rate. This explains something very important. Why holding everything else constant? If interest rates are higher, less investment spending takes place. You can imagine all across our country, all these investment projects that are on the margin, so to speak. As interest rates rise, more and more of them flip from worth it to not worth it, thereby reducing investment spending in our economy. To address this on a very deep level for a second, interest rates are more than the return on money. In economics, they represent how we value the future versus the present. The higher interest rates are, the less the future is worth today. Now let's give you a chance to crunch some numbers as well. We'll do a very similar investment decision. You're thinking about buying a piece of land for $70,000. And somehow you know with certainty that you'll be able to sell it for $100,000 in 5 years. Is it worth buying this lot of land? Well, trick question. In order to answer that question, of course, you have to know your interest rate. So let's do this twice. At an interest rate of 5% and an interest rate of 10%. Go ahead and pause the video now and give this a shot before we talk about the answers. Okay, let's go ahead and discuss our answers. So first, at the 5% interest rate. This of course makes it more likely that it's worth it because the interest rate is lower. But let's check if it's worth it. We only have one number to convert, the 100,000, because that's in the future. 70,000 is already a present value. So let's take 100,000 divided by 1 plus 5% to the power of 5 years in the future. That's $78,352. So it is worth it to buy this land since its value will exceed its cost. Let's try it again at the 10% interest rate. You can already expect where this is going. Same formula, $100,000, but this time divided by 1 plus 10% to the power of 5. This makes the present value of the land only $62,092, less than the cost of $70,000. So now it's not worth buying. This is the fundamental math behind investment decisions. And our first topic for today. But you're probably already asking yourself, well, it would be really nice if for any given investment decision I knew for sure what it would yield in the future. The second major problem with money in the future, of course, is that it is surrounded by uncertainty, or as it is referred to in finance, by risk. So risk in finance has a subtly different meaning from ordinary English. In ordinary English, we typically refer to risk only as the chance of something bad happening. In finance, risk is typically used to describe the uncertainty surrounding a payoff, both in the good and the bad direction. Let me give you a simple example. Imagine I offered you to toss a coin. A fair coin, 50-50 chance. And here's the gamble I offer you. If this coin comes up heads, I will give you $1,000 cash right now. But if it comes up tails, I take $1,000 from you. And let's say this contract is perfectly enforceable. I've got $1,000 cash on the table, and I've got the sheriff with me. If you lose and you don't pay me, we might auction off your car or your computer. I'm going to get paid. So here's where it gets interesting. I need you to put yourself into this position. Make yourself believe for a second that I'm actually offering you this gamble for real life money. And now ask yourself, how do you feel about this gamble? If I approach you, would you say, yes, let's go ahead and toss this coin? Or would you say, you know, I'm good, why don't you play this game with somebody else? Most people, when confronted with this particular gamble, will say, no thank you, I'd rather not. Not everybody, just most people. These people we refer to as risk averse. If presented with a fair gamble, they would rather not play. What do I mean by a fair gamble here? Well, if you've already taken statistics, you know that the fairness is evaluated as the expected outcome of this gamble, or in other words, the average payout, if you will. There's a 50% chance of a plus $1,000 payout, a 50% chance of a minus $1,000 payout. That means on average, the payout is 0. On average, you are as well off taking the gamble as declining it. But that's only on average. The average can't actually ever happen. There's no scenario where you end up winning or losing nothing. If you take the gamble, you either come out way ahead or way behind. This is what we refer to as risk. And most people look at that situation and think to themselves, while winning $1,000 would be really nice, losing $1,000 would be much more bad than winning would be nice. So let's walk away from this. But of course, this is economics. So we've got a nice mathematical model to represent this idea of risk aversion. It's based on the idea of the utility function. You might have heard of the concept of utility in a philosophy lecture already. It's a bit of a term of art. It's basically your subjective well-being. If you want to substitute the word happiness with utility, and you'd be close enough. Now, your utility depends on very many things in your life. But of course, the one we're going to be talking about right now is money. Not to suggest that just money matters for happiness, but let's just focus on the money aspect for a second. If we graph how wealthy someone is, their net worth here on the x-axis, versus their utility on the y-axis. Typically, when this phenomenon is studied in economics, you end up with a relationship that looks a little bit like this. Not entirely surprising. An increasing but concave curve. So what's going on here? Well, your current level of wealth is associated with a current level of utility. Again, holding all the other things in life that make you happy constant. Now, if you were to increase your wealth, your utility rises. But how much it rises depends on by how much wealth you already have. If you have very little wealth, adding wealth has a big effect. If you have very much wealth, adding wealth has a smaller effect. This is referred to as diminishing marginal utility. Basically, imagine you're on the way driving home and you get asked by somebody for a little bit of spare change. But you're feeling generous today, so you hand them a $100 bill. Imagine how much their utility for that day is going to rise. Now later on that night, you go to a party and you run into Bill Gates. You live a very interesting life. And you're like, oh, Bill Gates, I'm a huge fan. Here, have $100. Now he'll probably say, oh, that's pretty cool. This random person gave me $100, but how much is it going to increase his utility? By a much smaller amount. That's because of how much wealth he already possesses. So with this detour into the utility function, let us look at how this can explain risk aversion. So I offered you a gamble, and currently you have a level of wealth associated with a certain amount of utility. Now this gamble had two possible outcomes, 50-50. First possible outcome, we take your current wealth and we subtract $1,000, so your utility falls. Second outcome, heads, you win $1,000, your utility rises. In statistical terms, this gamble is fair, because if we look at the expected or average outcome on the x-axis with respect to your wealth, on average, your wealth post-gamble is at the same point as pre-gamble. But that's not what matters for most of us. What matters for most of us is utility. So let's have a look on the utility axis of the results from this gamble. Winning increases your utility by less than losing decreases your utility. So if we take the average of the two post-gamble outcomes, the win and the loss, the average of these two, the average is actually below where you are before you take the gamble. So you look at that situation and think to yourself, I would rather not. That's risk aversion. Again, this is fundamentally a behavioral principle. Not all people come built this way, but most of us, maybe 70 to 80% of us. And because risk aversion is so common, there are a lot of tools in finance that are designed to reduce the amount of risk, that is to say, uncertainty we face in our lives. There's a good chance you're already familiar with the two big ones we're going to discuss. But what I need you to learn about is that both of these major ways of reducing risk in our lives have well-known systematic weaknesses. And you have to be aware of those so that you avoid big mistakes. Let's talk about the first way of managing risk. Insurance. It's probably the first thing that comes to mind. Now, insurance is a pretty basic concept. Take a group of people that are facing a risk and you have them pool their money in order to reduce that risk. So for example, let's say we have 10,000 homeowners who conveniently own 10,000 identical homes. And each of them has a 1 in 10,000 probability that their home burns down. So for the entire group, you're expecting one house will burn down. For each homeowner, that's a very low probability. But the risk, the consequence of losing your house, probably the most valuable thing you own, is huge. So if you're risk averse, you're very uncomfortable with this. A small chance of this terrible loss. Now comes the concept of insurance. What if each of these homeowners puts 1/10,000th of the value of their home into a common pool? So now we have a pool that's worth one house. And then whoever's house burns down, we give them the pool of money. So what we've done now is we've taken away the small chance of losing everything. We've substituted it with the certainty of a small loss. That's the insurance premium. You will be paying 1/10,000th of the value of your home whether something happens to you or not. But assuming you're risk averse, of course, this leaves you better off. So you'd like to get that insurance. All right, that's the basic concept of insurance. But there are well-known weaknesses to insurance, which is why insurance can never insulate us from all risk in our lives. They also relate to some of my favorite terms in economics. The first one is called adverse selection. So in general, selection refers to the process by which a subgroup is picked. Imagine not all homeowners have to have insurance. They can choose. Only some of them end up buying. That would be a selection process. Now, we wouldn't need to talk about that if this selection was random, if the people who buy insurance are similar to the entire group of people. But that's not how insurance works. Insurance has adverse selection. People who are more risky are more likely to buy insurance. Think of your decision to buy cell phone insurance. You probably think about, well, how often do I break my cell phone? And if it happens all the time, you're more likely to buy insurance. If you don't break your cell phone, you don't buy insurance. But this means the people who buy cell phone insurance have an above average chance of breaking their cell phones. That means the premium on that insurance doesn't reflect the average chance across the population of someone breaking their phone. It represents the chance of those that buy the insurance breaking their phone, which is a bigger chance, so a higher premium. And in a way, that's fair for the people who buy insurance. They are paying a premium that reflects their risk. Really, who's being priced out are the people who don't break their phones because they'd only be able to buy insurance at a rate that doesn't reflect how rarely they would need it to begin with. So they'll probably go without. That's the reason why not everybody's going to end up buying insurance. Second problem, moral hazard. Moral hazard refers to a situation that makes you, if you will, a worse human being. That is a hazard to your morals. Insurance is one of those situations. Once you have insurance, you are insulated from the consequence of the bad outcome. But the thing is, bad outcomes often aren't just chance. More typically, they are a combination of chance and our choices. So if you ended up buying that cell phone insurance, how about putting a case on your phone? All of a sudden, your decision to do that is altered because you still have to deal with the downside of a case. Now your phone is bulkier and uglier, but you're losing part of the upside. If your phone breaks, you've got insurance, right? Moral hazard. You're less likely to try to prevent a loss now. That's why it's highly unusual to be able to buy insurance that actually covers 100% of the loss. Often there is a deductible where you have to pay a little bit, even if you are insured and something bad happens, in order to maintain some incentive for you to watch your behavior. That's insurance and two of its major problems. Let's talk about the other major way in finance of dealing with risk. That one, of course, is diversification. The idea that you can reduce risk without even involving other people, just by yourself, by spreading out the bets you have to take in your life. So for example, that coin toss, one coin toss plus minus $1,000, very risky. What if you had to engage in that gamble, but you had an opportunity to, instead of tossing one coin for plus or minus $1,000, to instead toss the coin 100 times in a row for plus or minus $10 each? The extreme outcomes are unchanged. You might still win or lose a maximum of $1,000. But you know that this happening has become much less likely now. You would need heads or tails 100 times in a row for that to take place. You might want to ask some questions about that coin if that's how this plays out. This principle is called diversification. And of course, it is most famously cited when we look at buying stocks. When you save for retirement, assuming you put some of those savings into the stock market, will a competent financial advisor tell you, well, you should take all of your savings and all put it into one company? Of course not. That'd be crazy. That's because you'd be exposed to all the risk that is specific to that one company. A competent financial advisor will tell you, spread this out across many types of companies. In fact, they might even advise something like a mutual fund that spreads the money out over 1,000 different companies, thereby reducing the risk that is specific to each firm. But diversification also has a limit. There exists risk in the stock market that affects all companies at once. We refer to this as market risk. And this you cannot diversify away from. So you have to be aware of its existence. Let me show you a famous graph where we ask ourselves the following question. What if we look at the companies in the US stock market? We now have data on that for over 100 years. We ask ourselves, what if you had just randomly across time put your money into one of those companies? Now, if you had put your money into just one of those companies, that would have been a more risky decision than if you had, at any point in time, randomly picked 10 companies or 20 or 30 or 40 to spread your money out over. So let's graph, on average, what would have happened. On the x-axis, we will graph the number of companies you would have split your money out over. Now, the average return would be the same. It's just averaged across all the companies. They'll be earning the same level of return no matter what you choose here. But the riskiness will be different. How much that return varies depending on how many companies you choose for your portfolio. We will use the concept of standard deviation to measure how spread out these results would be. If you've already taken statistics, you're familiar with standard deviation. If not, here's what you have to know. Bigger number means the returns were more spread out in both the positive and the negative direction. Bigger number means more risk. And here's what this graph would have looked like for the US stock market. If you put all your money into just one company, your return would have been subject to about a 50% standard deviation. A huge swing. But if you spread it out over just 10 companies, that's not even all that diversified yet, you would have cut that risk more than in half. And as you add more and more companies, the risk keeps falling. Great. And I'm not opposed to diversification. In fact, I think it's one of the great free lunches in economics where you get something for nothing. Same average return, lower risk. Yes, do that every time. But you look at a graph like this, and then you look at, for example, a mutual fund that has 1,000 companies in it. You might be tempted to say, well, that's a very safe investment then. But it isn't. It's only safe in having eliminated a lot of firm-specific risk. But there is an underlying market risk that doesn't go away, even if you spread your money over all publicly traded companies. So just because something is diversified, even though diversification is good, does not mean it's safe. At its core, this was the mistake that led to the big financial crisis in 2008-2009, where banks and investment firms treated spreading your investment out over many mortgages as safer than that investment actually was. All right, so we've now talked about risk and two ways of mitigating risk. Both of these ways are incomplete. Insurance and diversification cannot eliminate all risk. That means somebody in our financial system has to be willing to take the remaining risk. And in exchange, of course, they'll want to be paid for it. This leads us to another very famous graph. the concept of the risk-return trade-off. Again, we'll take the example of saving for retirement because we've got lots and lots of stock market data over lots and lots of time. We're going to compare how those stocks do to what's sometimes called a risk-free asset. That's not entirely fair, but for our purposes, it'll be close enough. And that's buying US government T-bills, bonds that are of a very safe type. So what you have to decide fundamentally is, how do you want to construct your portfolio? You can put everything into the safe asset, in which case there will be no risk. Standard deviation is 0. The US government has never defaulted on its debt. But historically speaking, your return will be lower. On average, over a very long time period, it's been 3%. Of course, at any given point in time, it varies what the level of interest rates is. Right now, in 2020, interest rates are much lower than that. If, on the other hand, you had put all your money into stocks, and not foolishly, fully diversified across lots of different stocks, you would have earned a higher return of maybe 8% per year. But you're also facing a standard deviation of 20%. So there are lots of years where you're losing money. Ultimately, you have to decide what mix of assets you're looking for. The more risk you put into your portfolio, the higher your return will be on average, but also the more spread out that return will be. There's ultimately no correct answer to this question. This depends on your personal risk preference. If, however, you are encountering an investment that's promising a higher rate of return, you should always ask yourself, where's that underlying risk? Do I really understand what it is I'm buying? Super. So this is risk, insurance, diversification, and return in our financial system, which leaves us with a final point. So what about our system as a whole? How good is it at managing this risk? How good is it at accurately pricing assets so that their expected returns reflect the risk they represent? This question is often phrased in terms of the efficient markets hypothesis. If you've already taken microeconomics, you've encountered this term of efficiency. Roughly speaking, efficiency means that a market works correctly. So often we ask, for example in microeconomics, is this market efficient or does it suffer from market failure and require some correction? In finance, the idea that these asset prices, stocks and bonds and more complicated things like mortgage bonds, for example, that those are priced correctly is referred to as the efficient markets hypothesis. The hypothesis that the markets for these assets are efficient, that they work correctly. Now, how efficient financial markets are is always a subject of a lot of controversy. Let me take you through the reasoning for and against the idea that financial markets are efficient. It's all based on, ultimately, some deductive type of reasoning and then some testing. If the stock market is efficient, that means it would be informationally efficient, among other things, meaning that the price of every stock would reflect all publicly available information about that company. There would be no systematic mistakes in stock prices. But there's a very interesting implication of this. If all the publicly available information is already in the price of a stock, then it could no longer be used to predict how the price of the stock would change, because it's already baked into that price. So from the perspective of one point in time, where that stock goes should be unpredictable. In statistics, we refer to such a variable as following a random walk, if it's unpredictable in a very strong sense. We might know on average that those prices go up, but for any specific stock, we'd be unable to distinguish how it's going to move relative to that average. But if that's true, if stock prices are unpredictable in a strong statistical sense, that means there should be no way to systematically beat the market. It would be the same as betting on coin tosses. If you have lots of people trying, yes, you will have some that'll have incredible winning streaks. But that's because they got lucky, not because there's actually a way to play the coin toss more effectively than anybody else. So how can we test this, whether these markets are efficient? Well, fortunately for us, there exists a whole universe of mutual funds where some are trying to do better than the market. Some mutual funds, they simply try to do as well as the market, or at least as a given stock index representing a part of the market. They are referred to as index funds. Other mutual funds try to pick those stocks that'll do better than average. Sounds like a good idea, right? Obviously, they'll be paying the people doing the picking a lot of money because there'll be hefty competition to hire the best stock pickers and lots of technology and support staff to help them out. Again, just like with a coin toss, some of these fund managers will end up with great winning streaks, others with terrible losing streaks. But if there is a system to do well, if there was a way to do this systematically, they should be able to eke out an advantage against those index funds. Well, the nice thing is, we can observe this because mutual funds have to report their returns. And Standard & Poor's does a really nice job of summarizing this in their SPIVA scorecard that they publish every year. So we're now going to look at, for a 15-year period, from 2004 to 2019, how did the index funds do following the S&P 500? S&P 500 is an index of large American companies. On average, those funds earned 9%. Now let's compare that to the managers who are investing in the same sorts of companies, so-called large caps. If there's a system that beats the market, they should do better than 9% to earn those fat fees. But how do they do on average? A lower level of return. And we can play this game for various types of sizes of companies you can invest in. If we look at so-called mid caps, the index does better than the actively managed funds. If we look at small caps, again, the index does better than the actively managed funds. So if we look at these results, as an economist, to me, this is incredibly strong evidence that the financial markets are in fact efficient. Because if we have people being paid lots of money, and these are some of the brightest people that our country generates, and on average, they can't even beat the index, let alone work out an advantage. Well, that suggests to me that these markets are highly efficient. Except, of course, what about the other side of this? If a market is efficient, that's not market failure. If a market is efficient, that means it sort of handles things by itself, and you don't need government intervention to make it work. But let's look historically now. Can we think of some recent times where what markets were doing didn't look efficient at all? Absolutely. Psychology has reared its head here. For example, all the way about 100 years ago, John Maynard Keynes, a very famous economist, observed that stock prices seem to be driven by animal spirits. That's an oldie-time term, but part of it survives today. Even today, we talk of bull markets and bear markets. More recently, in the 90s, during the so-called dot-com bubble, Alan Greenspan looked at the stock market and observed that there might be irrational exuberance. The man had a way with words. But of course, we're in the 21st century now, and we refer to this type of situation as a bubble. A bubble is a situation where market and asset prices are no longer based on what assets are fundamentally worth, but instead just based on speculation about being able to sell it to the next person before this thing falls apart. And when that correction comes, it's nasty. And of course, if in an efficient market you can't systematically beat the market, then in a bubble you can. If you realize that we're in a bubble, by shorting the assets that are in a bubble, you might be able to make a lot of money. The problem is, we're not quite certain how possible it is to realize that you're in an asset bubble before it has ended. And that was our discussion of some of the basic tools of finance. I'll see you next time.